Hey, what is up, you guys? It's Josh here. This video today is about how to begin investing. This is like an investor's 101. If you're somebody who's looking to get into investing, but you've never really dabbled in it, you don't know much about how to get into the stock market, this is a video that helps you kind of prepare yourself for what you can expect while investing. Now let's get right into the video. All right, guys, so now we're looking at a spreadsheet that I created. Essentially, it is a rough breakdown of the kind of things you can expect when investing in the stock market. So what we're looking at here is I've got a number of different categories. This would be your years involved. Essentially, what this is if you're starting, this is year 1, 2, 3, 4, year through 15, just to give you a rough idea of what it would look like if you're an investor and you're just now getting started. What you could expect to see in the market. Of course, with the market, guys, one very important thing to realize is that none of this is guaranteed. The stock market can be a very volatile place, and at times it is possible to lose money. So don't go into this thinking, yes, I am guaranteed to make the numbers that Josh has on the spreadsheet. Again, this is just a rough example of what it could look like when you're investing. Now, that being said, these numbers here, what I took into account is, let's say you're investing $1,000 a year. You're like, you know what, I'm saving up a little bit of money. I want to start to dabble in the stock market. What happens if I put $1,000 a year into the stock market? Well, there's a couple things that would happen with that being the scenario. But before we get into what it looks like down the road, let's first look at this dividend potential column here. And what this dividend potential column highlights is essentially, if you're buying dividend yielding stocks, what could you expect to make in funds from owning stock that gives you dividends? A dividend is essentially a breakdown of profitability at the end of one's company's month, quarter, or semi-annual, even annual report. And what they will do is they will pay out to their shareholders a portion of that profitability, and that is what we call a dividend. So what I have over here is this dividend yield little section. My stuff here assumes that your average dividend yield is going to be 3.5%. So say you've got $1,000. In any given year, you could expect to see 3.5% in a return, or $35. So what we're looking at here is a market growth on average of 6%. Now, of course, the market is volatile. You could see years where you've got a percent growth. You could see years where you've got 3% decline, which doesn't happen regularly, but it has happened in our nation's past. So that's one thing to make sure you keep in mind. We've also seen times where the average growth rate has been near 10%, even more. So it's important to know that that is very, very, very volatile. There's a lot of fluctuation there. So don't think that, yes, 6%, that's the number and I'm sticking to it. Again, this is just so you can see potential earnings moving forward. Now, what I want to get into is a calendar date. So let's say you're somebody and you're looking at this video and you're going to get into investing on January 1st of 2022. You're putting $1,000 in the stock market and you're going to buy a number of different stocks, maybe some S&P 500 index funds, something that's relatively basic. You're going to buy some Apple, you're going to buy some REITs, which is something that essentially involves a company that owns real estate or invests in the real estate market that pays out dividends. So let's say you're averaging a 3.5% dividend yield, as I have here in this example, and you invest $1,000 at the start of your year. You could assume with a 6% market growth that at the end of the year, you would have $1,060 in your account. Now, this dividend potential shows 37.10. The reason being is because it's taking into effect market growth. Now, the way I have the spreadsheet, again, it is at the most simplistic terms. This number would actually be 35, but this is assuming that with that market growth, since it's 3.5% of your total value, this is actually going to factor that there would be dividend increases, assuming that the dividend yield would grow with the share price of the stock. That's not always the case. That doesn't always happen. But just for this example, let's assume that it does. It's always reflective. You've got 3.5% of whatever the value in your account is. So at the end of the year, you would have made $37.10 in dividends on top of that $60 growth in the market. Year after year, you continue to invest, let's say that $1,000. You see it grow because now you've got the $2,000 from both the first 2-year contribution, then you've got some market growth, and that continues to stack on top. It compounds, growing that 6% year after year on top of the amount that you had already had invested before. And in year 15, it looks like your total value is $24,672.53, assuming the average market growth is 6% year after year. Now, remember, 6% growth is the number we stuck with. That could mean that you have 1 year that's 4%, 1 year that's 8%, 1 year that's 2%, 1 year that's 10%, but at the end of the day, it averages at 6% growth, which would get you to $24,672.53 in year 15. Well, your total invested amount is really only $15,000. So when you subtract the two from each other, you're looking at actually having made in capital gains. Now at this point they're unrealized, meaning that you haven't actually sold any of your shares. So essentially you can't count it as being income because it hasn't actually brought you any income. It's just out there floating in the market as a value that's been assigned based on these companies' profitability, their assets, a number of values. And you're left with, it looks like it would be $9,672.53 of what could be profits. If you sold everything at that very instant, you would have that much in profits over these 15 years. But now wait, let's look at the dividends. So year after year, you notice the dividend amount grows. In year 15, you could expect to make $863.54 just from holding that stock that you have currently. So when you get to that year 15, if you do maintain that average of 3.5% dividend yield, you could expect to earn $863.54 in this specific scenario. Again, it's not guaranteed, let's not forget. So when you go ahead and you break down the potential money made or your profits, if you sold at the end of year 15 after accruing those dividends, after building that equity by putting $1,000 in year after year, you could expect to make $15,653.37 in profits. Now again, after 15 years and $1,000 a year, you might say, wow, that's really not that much. But you got to remember, you're also making back that $15,000 that you invested at this point, meaning that realistically, you just got $30,000 back into your pocket. It's essentially like it was a savings account for you, but you managed to make a lot more than you would have from the low interest rates that your savings account will yield. Now, if we were to change these values, let's say you're somebody who is like, you know what, I'm going to put a little bit more money aside. I'm really going to work hard. I'm going to grind. I'm going to put as much money aside as I can. You say, you know what, I want to put $500 a month aside to invest. Well, this is not going to be the most reflective account in this spreadsheet because, again, this is year after year. This doesn't take into account the compounding of potential monthly investments, right? So you have to realize that this is year after year. It's not going to be 100% reflective, but it will give you the general idea. Now, let's put this value at $6,000, assuming you're saving $500 a month. This is when things really start to look different. So this is where you've got $6,000 up front for that first year. You would actually expect to gain, given the 6% growth per year average that we've decided to use for this video, you could expect to have $6,360 in your account or $360 of market growth for the year. Now keep in mind, this value is very different than what we saw when you only invested $1,000 a year, because that was $1,060 at the end of year one. This is $360, which is, again, 6 times more in terms of market growth using that 6% growth. Your dividend also goes up. So now you're looking at year one making $222.60 of dividends. That's potential. Again, none of this is guaranteed, but if it's diversified and you're looking at an average of 3.5% dividend yield across all of your stocks, this is what you could expect to gain in dividends. Let's skip down to year 15. So here you had $90,000 total invested over these 15 years. The value in your account is $148,035.17. Again, speculative. But that is very, very different than what we were looking at when you only put in $1,000 a year. This is why that compounding growth is so essential, because it really gives you the opportunity to just build on top of itself until you essentially snowball into making more and more and more the more you put in. When we're looking at the dividend potential, in year 15, this is what you would be able to essentially bring in yearly in dividends, $5,181. Now, again, this isn't guaranteed. Let's say you have 3.5% average dividend yield. That's what you could potentially expect to make. Dividends change. Companies will increase or cut dividends depending on their profitability. You can never count a dividend in as being a guarantee. You can only expect that you may have it. Again, since this is speculative, we're saying that it's possible, but it's not guaranteed. At the end of the term, 15 years worth of compounding that growth and then building those dividends year after year, potentially you could have made $35,885 of just dividend profit over that 15-year term. For a total, if you were to sell at the end of year 15, what you would expect to potentially see in profits is $93,920.25. Guys, that is substantial money. Very, very different than what it would look like if you put $90,000 into a savings account. I don't have the numbers pulled up here in front of me, but they typically have such low interest rates that it's pennies on the dollar of returns, whereas you are essentially doubling your overall investment in this market scenario, which is very, very significant, especially when compared to a CD or a savings account. I hope this video helped, guys. If it did, please leave a like. Subscribe if you're not subscribed already. I plan to bring more tips, more info on how to invest. I'll have a working spreadsheets that I'll oftentimes just bring into videos to give you scenarios on here's what you could expect to make, here's what you may be making, and not to mention there are other investment opportunities that we can discuss on the channel moving forward. So if you have ideas and things you want me to do a breakdown on for potential profits, put those in the comments below. Let me know your thoughts, and please, please check me out next time. Thanks, guys. This has been Josh. It's been real.